Hello, we are going to talk about credit scores, and I am going to help you skyrocket your FICO score with 10 simple steps. To get started, the first thing you need to do is get credit. So, you have to get some credit cards under your name, and my number one tip is to start early. So, you do not have to necessarily be 18 years old to get your first credit card. And the best way to go about it is to obtain your credit card by doing my number one trick, which is piggybacking off of somebody else and their credit. So, when you are a teenager, you may not be able to get a credit card because you're not reliable, but you can always get added to a credit card of your parents or your friends that are adults. And the best way to go is to basically find someone who's pretty reliable. They pay off their credit cards every month. And you can also track your credit score by going to creditkarma.com and creating a free profile. So even after you open a credit card with somebody else, be sure to track the credit card score that you are getting on a regular basis, maybe every couple of months or 6 months. And basically, the way to piggyback is to find someone with a high credit limit, somebody reliable who usually pays off their card on a monthly basis. They're ideally not financially struggling or having a hardship in any way. They are pretty trustworthy. You rely on them. They're very reliable people. You can easily communicate with them by calling them or checking on things whenever you are needing to. And you can always get easy approval to be added to their credit card. They're very nice, they're kind, they're easygoing. You can talk to them, and they won't mind adding you to their card. So once you've found this person, you can definitely find more than one, but at least find one or two people that you can get added to their card. So I recommend maintaining this card as a co-owner. You do not have to hold this card in your possession. Let's say you found a parent who doesn't mind adding you to their card, but they do not trust you. And that might be for a good reason. I mean, you are young, and the first moment you have a card, you might be super excited to go spend some money. So in reality, this individual doesn't have to give you a card. You can basically say, hey, can you please add me to your line of credit? And instead of handing me the card, you can keep it, and maybe we can revisit this concept like in 6 months or a year when I am proven very reliable. And then you can even add some conditions, like for example, socially, try to see if maybe they will be okay with you spending $50 a month and then paying it off every month with a maximum of $50, and build up some trust. But the point is that you do not have to actually have the card in your possession. You do not have to actually use the card in any way, but you can still get the benefits of having that credit card open. And so the reality is they can be easygoing and provide you the card, so then you could actually use it and pay it off every month, or they can hold on to it and they could have control over the card and the account in its entirety to basically maintain all your cards that you had received early. So, if you've had a card for 5 years, 10 years, or even 1 year, but then you close the account, it will actually hurt your credit score. So be sure to, when you open your cards, maintain them. Do not let them close out. because the longer you have those cards, the more reliable you look to banks and the higher your credit score will be. So in reality, the reason why we are opening a card account when we're a teenager is because we want to build up that history. We want to get, banks to trust us and look reliable, and also we want the experience of having a card and paying it off, and through that you will build a good credit score. So when you open your card early, don't close it super quick or avoid closing it at all, even if you don't use it very much. My recommendation is to basically buy something every year. Go to Walmart, buy some gum, enjoy it, and just maintain the card. That is how you build trust with your credit score and increase it. And so step number 3 is your utilization ratio. Be sure to get a utilization ratio of under 30%. You may be wondering, what is a utilization ratio? Well, the utilization ratio is basically how much money on the card you are utilizing with respect to the total amount available to you. So this is a percentage. If you're using 30% of the total balance available to you, then you have a 30% utilization ratio. And if you're using, 20% of the card, you might have $200 balance on your $1,000 credit card limit. You in this situation would have a 20% utilization ratio. And so for me, my recommendation, if you want to improve your FICO score, you will want to maintain a utilization ratio under 30% by having, for example, $300 of the total $1,000 available to you, maintaining a balance of under $300. If you really want to improve your FICO score, you will want to maintain a balance under 15%, but at minimum, try for at least maintaining a balance under 30% of the total available limit on your account. Under 0 to 15% would be best as a ratio. So when you have a utilization ratio, let's say you've spent and maxed out your card, and you basically have, a $2,500 charge to your $2,500 maximum limit to that card, your utilization ratio will be 100%, and you will look really bad to the banks. The banks will basically see that you've maxed out your card. You don't look very reliable because you are overspending, and most people cannot pay a full balance when they've maxed their card. So by having that utilization ratio, that percentage of use of the total value, then you can either impact your reliability, which therefore would impact your score. So to have the best credit score, you actually want to hold a utilization ratio under 30%. You want to utilize under 30% of the total amount available to you on your card. And my recommendation is to actually maintain a utilization ratio of 0 to 15%. That will more positively affect your credit score and help you improve your credit score versus maintaining one at 30%. So the next tip would be to get removed from your credit cards that have a high utilization ratio. So let's say, you were a teenager and you went to your mom and you said, "Hey, can I be added to your credit card?" And your mom said, "Sure, why not?" And then, 5 years later, you forget about it, but you realize, OMG, your mom has just racked up a whole bunch of debt on that card. Well, at this point, you basically have a high utilization ratio. The card has a lot of money spent on it, and it is not getting fully paid off at the end of each month. And so the first thing you want to do with this step is get removed from the card. So there may be cards that you have where you have extensively utilized that card and you're unable to pay off the monthly total balance. Well, if it's a card that you're not really responsible for the debt on, get removed from the card. If this is a card that, you have a high utilization ratio, but you earned the debt, it is your debt, and there's nobody else on the card. So in this situation, there's nothing you could do. Pay off your credit cards and reduce your balance the best you can. But the point with this tip is if you're a co-owner on a card and the card has a high utilization ratio, it's utilized over 30%, then definitely get yourself removed from that card. So the next step number 5, is to increase your credit limits. So before we discussed our utilization ratio, which is the amount or percentage of the total. Well, if you increase your credit limit, you will have a higher amount of money available to you. So your total credit limit available to you, if you increase it, you'll minimize impacts to your credit score. And when you're forced to carry a high amount of debt, that debt on your credit card will actually affect you less. So, for example, if Jane has $25,000 credit limit with $300 charged to her card, she has a 1.2% utilization ratio, which is pretty low. And so that looks very, exemplary to a bank. You look like you are very low risk. You've only spent $300 of the $25,000 available to you, so you look like you are pretty reliable. And for that reason, your credit score will reflect that. You will look really amazing to the banks. But for example, if you have another person, let's say Jenny, who has, instead of a $25,000 credit limit, she has a $2,500 credit limit. And she charged the same amount, $300, to her card. Instead of having a 1.2% utilization ratio, she will actually have a 12% utilization ratio. So because she has $2,500 available to her and she spent 12% of that, $300, this means that with the 12% utilization ratio, she will look like a worse, less reliable person when it comes to the banks. Her credit score will be impacted a little bit more. And so the point is, two people can charge the same amount on a card, but the person with the higher limit and the more available credit to themselves, they will be in the better situation. So basically, do not increase your credit limit because, you want to spend more money. You don't want to get trapped into high interest rates that'll overwhelm you. Make sure that you have, self-control and you pay off your cards and be sure to make payments every month. So, you don't want to increase your limits for all the wrong reasons, but the reality is you do want to increase your limits in general. So don't spend more, but request a increase in your credit limit every 6 months or every year, depending on your preference, and just maintain a higher credit limit. By calling your bank every 6 months or however long you want to wait before calling them again, you can basically increase your limit. And it could increase 6 months. It could increase a small amount, or it can increase a larger amount. But just increasing it in general is a win, because when you have a higher limit and you charge a amount to it. The higher the limit, the less you will look bad when you charge that certain amount, and so the less impact to your credit score when you're actually utilizing your credit card and spending on it. So when you do increase your limits, just note that you will be having a hard or soft pull on your credit score, which may temporarily affect your score. But in the long term, by pulling your credit and increasing your limits, you will improve your credit score over the long term. And so the next step number 6, is to maintain activity on your cards. So as I noted previously, if you don't use your cards, they may get closed out and they may end your credit card or your rewards card. And these cards will, once closed, that may affect your credit score. So for example, there are reward cards and store cards and certain credit cards that require a annual use, or they'll cancel them unexpectedly. And that is why I recommend going to the store, buying gum, paying off your card, maintain some activity on each of your cards. If you're not utilizing them actively and you're not using your cards, then the bank's gonna not really look at you as good. And your credit score just will not be as good as it could be if you actively used your cards, either on a every several months basis or at least every year. So step number 7 is to maintain a non-zero balance. And so the reason why you would want to not pay off your cards in full is because when you pay off your card in full, the bank will basically get no money from you. They won't charge you interest on the remaining balance, and because of that, banks won't like you and your credit score will actually be impacted. So don't pay off your full balance if you want a higher credit score. And basically, the way to do this is to make a payment, but maintain, for example, like $20 on your card at the end of each month. Sure, you're going to get like a 20% interest rate or whatever the interest rate is on your card, but you're getting a few dollars of interest that you're going to pay with regards to that $20. But in the long term, you will actually improve your credit score. So it is better to leave and maintain, a $5 or $10 balance on the card each month instead of paying off the card 100%. Banks want you to maintain a balance because they can charge you interest on that balance. So when you maintain the small balance, if you do not wish for your FICO score to be impacted by the fact that you're always paying it off and maintaining a zero balance, instead you would maintain a super small balance. Your FICO score will be happier for it, and it will improve. Your FICO score will be a lot higher if you maintain a small balance. So the next step or tip is maximize the age of your credit cards and your FICO score. So the more history you have for the longer amount of time, the better your score will be. So in order to have a card for a longer amount of time, you do want to start early, as I said, for step number 1. The longer you have your credit card, the better. The age of the credit card or the amount of years that the credit card was owned will mean that you are less risk to the bank. And this is why step 1 is to maintain a card early. Obtain your credit cards as soon as you can, and even before age 18. And then once you have your cards, maintain them for a long amount of time, because the age of your credit cards will affect your FICO score. If, for example, you have 5 credit cards and 3 of your cards were opened 1 year ago, but the other 2 cards were opened 3 years ago, overall you look like a very, new, unreliable credit holder. So the reality is, if you open a card and maintain it for 7 to 10 years, you will look way more reliable. Now, if you couple this with, and you piggyback off of someone when you're a teenager and you open up a card, you don't even have to be a teenager actually. But if you piggyback with someone, basically, find a co-borrower that you can, open a credit card with them and basically get added to their card. Go to your grandpa and grandma and say, hey, can I please be added to your card? Honestly, you could even help them pay off the debt. Like, that is the pricelessness of this trick or tip. I would rather pay off my grandpa's credit card and be on the card than to simply not be on the card. Because let me tell you, when you approach your grandparents and say, hey, I would love to improve my credit, I want to portray that I have a really reliable character and get a really good FICO score, and I would love to be added to your credit card. I'll help you make payments because you're a nice person, and helping grandma and grandpa is a great thing. But basically, their cards are going to have the highest age. My mom and dad, they might have a card for 15 years, but if I go to my grandpa or grandma, their card may have existed for 30, 40 years. And so the reality is, by having that 40-year-old card on my credit, I will look so reliable to the bank. And so what the bank does when, they send out your report and your FICO score is created, your FICO score will actually take an average of all of your lines of credit. The average age of those items will basically display your reliability and affect your credit score. So, if you have cards that are mostly 5 years old or less, you will look less reliable and have a lesser FICO score. But if you get added to a credit card that, has 20 plus years in age, all of your card ages will average, and that card that's super old or has a high age will actually enhance your overall credit score. So increase the ages of your credit. Don't close your accounts, and feel free to get added to other people's cards, and by increasing the age of your overall average credit score, lines of credit, you can improve your FICO score. So step number 9 is to diversify your credit report. And in order to do that, you will want to acknowledge the fact that credit cards, store cards, mortgage loans, auto loans, they all affect your FICO score in different ways. So be sure to diversify what you have listed on your credit report. Each item is going to send a report to the credit bureau, and when this report is sent out, if you have more diversity with regards to the types of cards that you have, your score will be heavily improved. So maintain a diverse types of credit on your credit reports. And so, for example, if you have a limited quantity of lines of credit, that will actually affect your FICO score. So, for example, Bob only has credit cards, but he does not have a mortgage. He's never owned a car. That will actually impact his credit score. The best thing Bob can do is open some credit cards, get a car loan, make payments, and if he can, buy a property, get a mortgage. Because the more types of credit that you have, the more diversity you can add to your report, the better. You will improve your FICO score overall. And this is simply because by having more diverse types of lines of credit, and then maintaining reliable payments to all of them by setting up, for example, automatic payments, the bank will look at you as very reliable because you're able to maintain all these different types reliably and make payments on them automatically with no issues. So the next one is to stop canceling your credit cards. So when you cancel your credit card, you should be strategic. If you're canceling your card for no reason, then you're doing it all wrong. So canceling your credit card should be a strategic action that you implement on purpose when the pros are outweighing the cons of maintaining the card. So as we all discussed, you want to have an older, age of credit. And if you cancel them or close the cards, then, regardless of using them or not, you're going to affect your FICO score. So instead of closing the card, just maintain it and don't use it. It's just better for your FICO score. If you close your card, you could actually affect the overall average age of your credit account profile, and so that will overall signify that you're a higher risk as a credit card owner. So maintain your cards, don't close them, don't decrease the overall average of your credit. Maintain higher credit limits if you can by, getting them increased every once in a while. So I hope you enjoyed these must-have tips. And I would love to see how you're doing and how your credit has improved in response. So feel free to drop a comment below and, share some feedback and words of wisdom from, all of your experiences implementing these tips. We all deserve a chance at a really good FICO score. And in reality, a good FICO score is super important to your life, especially in this modern day society. So if you don't have a good credit score, your everyday life will be impacted. Your interest rates will be higher. Your insurance rates will be higher. Your ability to purchase a house will be impacted. Your ability to have a car loan will be impacted. So the reality is we all need to prove ourselves and our reliability and, maintain our lines of credit and make our payments, set them up to automatic payment, and, implement some tips to, increase your reliability and make sure that you look good to the banks. Because your reputation is important for a lot of different things in life, and by having a good, reliable FICO score, you'll also not just affect your life, but you'll affect all the different things that you can do within your life. So thank you so much. Well, have a great day.